What if I told you that a $2,000 check from the government could either change your financial future or disappear without a trace? What if I told you that the difference between those two outcomes has nothing to do with luck and everything to do with understanding one simple principle? Your income level completely changes what you should do with that money. If you're tired of wandering through life regretting how you wasted your last stimulus check, hit that subscribe button and like this video. Right now, the government is debating sending out $2,000 stimulus checks that they're branding as rebate payments from tariff revenue. Whether you're making $30,000 a year or $100,000, if we get that check, that $2,000 is arriving in your account with a question attached. What are you going to do with it? Most people will treat it like free money and blow it on things they'll forget about in 3 months, but here's what changes everything. The smartest move you can make with that $2,000 depends entirely on where you're at right now financially. Someone making $35,000 a year should do something completely different with their stimulus check than someone making $75,000, and both of them should approach it differently than someone earning 6 figures. This isn't about being fair or unfair. It's about understanding that your income level determines your biggest financial vulnerabilities and your best opportunities for growth. Let's break this down by income bracket, because the person who treats a windfall the same way regardless of their situation is the person who stays stuck in the same place forever. We're going to look at 3 different scenarios: people making under $45,000, people in that middle zone between $50,000 and $80,000, and people pulling in over $80,000 annually. Each group faces different challenges and different opportunities with that $2,000. Here's what you need to understand before we dive in. A stimulus check isn't just money, it's a test of your financial intelligence. It reveals whether you understand the difference between feeling rich for a week and actually building wealth over time. Most people fail this test spectacularly, which is exactly why they're still struggling 5 years from now, while a small percentage of people use windfalls to completely transform their situation. Let's start with the under $45,000 income bracket. If you're in this group, I need you to hear something that might sting a little, but could save your financial life. You cannot afford to treat this $2,000 like fun money. You're operating with such thin margins that a single unexpected expense could derail your entire financial situation. That broken transmission, that medical bill, that emergency trip home for a family crisis. Any of these things could push you into debt that takes years to escape. Here's your first and most critical move if you're in the low income bracket. Build or complete your emergency fund. I know this sounds boring. I know you'd rather buy something you can actually see and enjoy, but let me explain why this matters more than anything else you could do with that money. When you don't have emergency savings, you're one bad day away from financial catastrophe. Your car breaks down and suddenly you're putting $800 on a credit card at 24% interest. You get sick and miss a week of work and now you can't make rent. You're constantly making decisions from a place of desperation rather than strategy. And desperate decisions are almost always expensive decisions. That $2,000 stimulus check is your chance to break this cycle. Put it into a high-yield savings account that you don't touch except for genuine emergencies. Not, I really want this emergencies, real emergencies. The transmission fails, the hospital bill arrives. You lose your job and need money to survive while you find a new one. Here's what changes when you have that money sitting there. You stop living in constant fear. You can actually think about your future instead of just surviving your present. You make better decisions about work because you're not terrified of losing your paycheck. You avoid predatory lending that traps people in debt cycles they can never escape. But let's say you already have a small emergency fund, maybe $500 or $1,000 saved up. Your second priority with that stimulus money should be eliminating your highest interest debt. Notice I said highest interest, not highest balance. If you've got a credit card charging you 27% interest and a car loan at 6%, you attack that credit card like it's trying to rob you, because it literally is. Here's the math that most people miss. Every dollar you have sitting on a credit card at 27% interest is costing you 27 cents per year. That might not sound like much, but it compounds against you. Meanwhile, most savings accounts are paying you maybe 4 or 5% if you're lucky. You're losing 22 cents per dollar every single year just by having that debt hanging over your head. Put $2,000 toward a high-interest credit card, and you're not just reducing debt, you're giving yourself a guaranteed 27% return on that money. Show me an investment that beats that with zero risk. You can't, because it doesn't exist. Paying off high-interest debt is the best investment most people will ever make. but they don't do it because it's not sexy or exciting. Your third option, if you're in the under $45,000 bracket, and only if you've handled the first two priorities, is to invest in something that increases your earning power. This is where people get it wrong by thinking about nice to haves instead of need to haves. I'm not talking about a course on cryptocurrency trading or becoming a life coach. I'm talking about practical skills that employers will pay you more money to have. Maybe it's a certification in your current field that qualifies you for higher paying positions. Maybe it's learning a trade skill that's in high demand. Maybe it's getting a commercial driver's license, taking a coding boot camp, or becoming certified in HVAC repair. These aren't glamorous, but they're proven pathways to higher income. The key question to ask yourself is simple. Will spending this money allow me to earn significantly more within the next 12 months? If the answer isn't a clear yes with a realistic plan, don't do it. Save the money or pay down debt instead. The world is full of people who spent thousands on education that never increased their income by a single dollar. Now, let's talk about the middle income bracket, people making between $50,000 and $80,000 annually. You're in an interesting position. You're probably not living paycheck to paycheck anymore, but you're also not exactly comfortable. You've got some breathing room, but not much margin for error. This is actually the most dangerous income level, because you can afford to make expensive mistakes without realizing how much they're costing you. Your first move with that $2,000 should be maximizing any employer match on your retirement accounts. This is free money that most people leave on the table because they don't understand how valuable it is. If your employer matches 50% of your 401k contributions up to 6% of your salary, and you're not contributing enough to get that full match, you're literally refusing free money. Here's why this matters so much at your income level. Let's say you make $65,000 a year. If you contribute 6% to your 401k, that's $3,900 annually. Your employer kicks in another $1,950 for free. That's a 50% instant return on your money before you even consider investment growth. Put that stimulus check toward maxing out your employer match and you're making one of the smartest financial moves possible. But here's what separates people who build wealth from people who stay stuck at this income level. Once you're getting your full employer match, your second priority should be building what I call a lifestyle protection fund. This is different from an emergency fund. An emergency fund covers survival, rent, food, basic necessities. A lifestyle protection fund covers the life you've built, the ability to take your kid to the dentist without stress, to replace your laptop when it dies, to handle your car registration and insurance without scrambling. Most people at this income level live in what I call permanent medium anxiety. They're not broke, but they're not comfortable. Every moderately large expense creates stress and forces difficult decisions. Building a lifestyle protection fund of $5,000 to $10,000 eliminates this anxiety and stops you from making expensive mistakes when things go wrong. That $2,000 stimulus check could be the foundation of this fund or the piece that completes it. Once you have this money set aside, you'll notice something remarkable happens to your psychology. You start making decisions based on what's best long-term instead of what's most convenient short-term. You can afford to shop around for better insurance rates. You can negotiate from strength instead of desperation. You stop paying the poor tax, which is what I call all the extra money that desperate people pay because they can't afford to be strategic. Your third option at this income level is starting or accelerating investment accounts outside of retirement. This is where you begin building real wealth instead of just surviving comfortably. Open a taxable brokerage account and start buying index funds that track the overall market. Put that $2,000 into a diversified portfolio, and it becomes the seed money for financial independence. Here's what most people miss about investing at this stage. You're not trying to get rich quick. You're trying to build a machine that generates money while you sleep. That $2,000 invested in index funds averaging 8% annual returns turns into $4,300 in 10 years without you adding another dollar. Add to it consistently and you're building the foundation for the kind of wealth that changes everything about how you live. The key is understanding that every dollar you invest now is worth multiple dollars in the future. You're buying time freedom, option generation, and psychological security. These things are worth far more than whatever temporary pleasure you could buy with that stimulus money. Now, let's talk about the high earners, people making over $80,000 annually. If you're in this bracket, you need to hear something that might make you uncomfortable. Having a high income doesn't mean you're good with money. In fact, high earners often make the most expensive mistakes because they can afford to be sloppy with their finances. Your first priority with that $2,000 stimulus check should be conducting a complete financial audit. This sounds boring, but it's probably the most valuable thing you can do. High earners bleed money through lifestyle creep and unconscious spending. You're paying for subscriptions you don't use, insurance policies you're overpaying for, and convenience expenses that add up to thousands annually. Take that stimulus money and use part of it to hire a financial advisor for a one-time planning session, or invest in software and time to thoroughly analyze your spending. I've seen people at this income level discover they're wasting $500 to $1,000 per month on things that provide zero value to their lives. Finding and redirecting this money is worth far more than the stimulus check itself. Here's what happens when high earners get serious about their finances. They realize they could be saving $2,000 to $3,000 per month without changing anything meaningful about their lifestyle. They discover they're 1 or 2 strategic decisions away from financial independence instead of the 20 years they assumed they needed. But this only happens if you're willing to look honestly at where your money actually goes. Your second priority at this income level is maximizing tax-advantaged investment accounts. You should be maxing out your 401k contributions at $23,000 per year and potentially contributing to an HSA if you're eligible. That stimulus check could be the push you need to increase your contribution rates to hit these limits. Why does this matter so much at higher income levels? Because you're getting crushed by taxes. Every dollar you can shift into tax-advantaged accounts is a dollar that isn't being taxed at your marginal rate, which could be 24%, 32%, or higher when you include state taxes. You're not just saving money, you're avoiding giving a quarter or a third of it to the government unnecessarily. Here's the math that high earners miss. If you're in the 32% tax bracket and you contribute an extra $10,000 to your 401k, you're saving $3,200 in taxes that year. That's free money you get to keep and invest instead of sending to the IRS. Use that stimulus check to increase your retirement contributions, and you're playing the game the way wealthy people actually play it. Your third option at this income level is accelerating wealth-building investments outside of retirement accounts. This means maxing out taxable brokerage accounts, considering real estate investments, or potentially investing in a side business that could generate additional income streams. At your income level, you should be thinking about building multiple sources of wealth rather than depending entirely on your salary. That $2,000 could be the seed money for a rental property down payment fund, the starting point for a dividend-focused taxable account, or the capital for a side business that eventually replaces your job income entirely. The key is thinking strategically about how money can make more money, instead of just spending it on lifestyle upgrades you don't actually need. But here's where high earners often screw this up completely. They take that stimulus check and use it to justify a bigger purchase. They think, I got $2,000 back so I can afford to spend $5,000 on something I want. This is the mentality that keeps high-income people broke despite earning great money. You're using found money as an excuse to increase your spending instead of using it to build wealth that eventually makes work optional. Now, let's talk about something that applies to all 3 income brackets, but that most people completely ignore. The real value of that $2,000 stimulus check isn't the money itself. It's the opportunity to develop better financial habits that compound over time. Think of it as practice for handling future windfalls, whether that's a tax refund, a bonus, an inheritance, or any other unexpected money. Most people who blow a $2,000 stimulus check will also blow a $20,000 inheritance. The amount doesn't matter. What matters is whether you've developed the discipline to treat found money as an opportunity rather than permission to spend. The person who uses that stimulus check to build an emergency fund or pay down debt is practicing the exact mindset that eventually makes them wealthy. Here's what separates people who build wealth from people who just earn high incomes. Wealthy people understand that every dollar is a soldier in an army fighting for their financial freedom. They don't waste soldiers on stupid battles. They deploy them strategically where they'll have the most impact. That $2,000 stimulus check is 2,000 soldiers. The question is whether you're going to send them into battle or waste them on entertainment that you'll forget about by next month. Let's talk about the psychology of windfalls, because this is where most people completely lose the plot. When you receive unexpected money, your brain treats it differently than money you earn through work. It feels like free money, like bonus money, like money you can spend without consequences. This is called mental accounting, and it's one of the reasons why lottery winners go broke, and why people with high incomes still live paycheck to paycheck. The smartest thing you can do is treat that stimulus check exactly the same way you treat money you worked hard to earn. Because guess what? You did work for it. You paid taxes that funded the government programs that are now sending this money back to you. It's not free money, it's your money returning home, and you should treat it with the same respect you treat any other income. Here's a framework that works regardless of your income level. When you receive that stimulus check, immediately split it into 3 categories: foundation, growth, and reward. The foundation is your emergency fund and debt reduction. The growth is your investments and income increasing expenses. The reward is a small amount you allow yourself to spend on something enjoyable. The exact split depends on your income level and current financial situation. If you're under $45,000, maybe it's 80% foundation, 15% growth, and 5% reward. If you're in the middle bracket, maybe it's 40% foundation, 50% growth, and 10% reward. If you're over $80,000, maybe it's 20% foundation, 70% growth, and 10% reward. The point is being intentional instead of letting the money disappear into general spending. That reward category is important because financial discipline isn't about perfection or deprivation. It's about being strategic. Taking $100 or $200 from your stimulus check and spending it on something you genuinely enjoy isn't wasteful. It's acknowledging that you're a human being with needs beyond pure financial optimization. The key is making it a conscious decision rather than letting all $2,000 slip through your fingers without noticing where it went. Here's what nobody tells you about stimulus checks and windfalls. The real benefit isn't the money, it's the momentum. When you use found money wisely, you create psychological momentum that carries into your regular financial decisions. Suddenly you're more aware of your spending. You're more motivated to save. You're more interested in building wealth. That $2,000 handled correctly can be the catalyst that changes your entire financial trajectory. But it works the opposite way too. Blow that stimulus check on stuff you don't need, and you're reinforcing the exact patterns that keep people broke. You're telling yourself that money is for spending, that windfalls are for splurging, that financial discipline doesn't really matter. These mental patterns compound just like investment returns, except they compound against you instead of for you. Let me share something that might change how you think about this completely. That $2,000 stimulus check represents somewhere between 40 and 100 hours of work, depending on your income level. Would you work for 40 hours and then just throw the money away? Would you put in a week or 2 of labor and then light the cash on fire? That sounds ridiculous, but that's exactly what you're doing when you spend a windfall on things that provide no lasting value. Every financial decision is a trade-off between your current self and your future self. Your current self wants immediate gratification. Your future self wants security, freedom, and options. The question is, which version of you are you going to prioritize? Most people consistently choose their current self and then wonder why their future self is broke and stressed and trapped. Here's the brutal truth about stimulus checks and financial windfalls. They're a test that most people fail. They reveal whether you understand delayed gratification, whether you can think long-term, whether you're serious about building wealth or just fantasizing about it. The person who uses that $2,000 to build their emergency fund is demonstrating something more valuable than the money itself. They're demonstrating the capacity for financial discipline that eventually makes them wealthy. Now let's talk about some specific moves you can make depending on your situation. If you're under $45,000 and living paycheck to paycheck, open a high-yield savings account today and move that entire stimulus check into it. Don't wait. Don't think about it. Don't tell yourself you'll do it next week. Do it immediately before your current self can sabotage your future self. If you're in the middle income bracket and you've got high interest debt, make a payment on that debt the day your stimulus check arrives. Watch your balance drop and your minimum payment decrease. Feel what it's like to actually make progress on debt instead of just treading water. That feeling is more valuable than anything you could buy with that money. If you're a high earner who's been putting off getting serious about your finances, use part of that stimulus to hire a financial planner or pay for financial software that'll help you optimize your situation. The ROI on this investment is usually 10x or more when you discover all the money you're wasting and all the opportunities you're missing. But here's what matters more than any specific advice. You need to make a decision about what kind of person you're going to be with money. Are you going to be the person who has money pass through their hands without building anything lasting? Or are you going to be the person who treats every dollar as an opportunity to build the life they actually want? That stimulus check is a moment of truth. It's arriving in your account with a question attached. Who are you really? The person who talks about wanting to build wealth but never does anything about it? Or the person who takes every opportunity, no matter how small, to move closer to financial freedom? Here's what I want you to understand. 5 years from now, you're not going to remember what you bought with that stimulus check if you spent it on random stuff. You won't remember the restaurant meals or the impulse purchases or whatever else seemed important in the moment. But if you use it wisely, you might remember it as the moment you finally got serious about your finances. The moment you started building an emergency fund that saved you during a crisis. The moment you paid off the credit card that had been hanging over your head for years. The moment you made your first investment and started thinking like someone who builds wealth. The difference between someone making $40,000 who becomes wealthy and someone making $100,000 who stays broke isn't income. It's decision making. It's understanding that wealth isn't built by how much you earn. It's built by what you do with what you earn. That $2,000 stimulus check is a perfect opportunity to prove to yourself that you're capable of making smart decisions even when nobody's forcing you to. So here's a potential action plan, customized to your income bracket. Do some research and see if it fits your goals. Under $45,000, put $1,800 into a high-yield savings account for emergencies and use $200 for something that brings you genuine joy. You're building discipline, not practicing misery. Middle bracket $50,000 to $80,000. Put $1,000 toward maxing your employer match or building your lifestyle protection fund. Invest $800 in index funds through a brokerage account and spend $200 on something meaningful. Over $80,000, use $500 to max your tax-advantaged accounts or start a wealth-building investment. Put $300 toward a financial audit or planning session and spend $200 on an experience rather than more stuff. These aren't rigid rules, they're frameworks to help you think strategically instead of emotionally. Adjust them based on your specific situation, but don't abandon the core principle. Found money is an opportunity to accelerate your financial progress, not permission to increase your lifestyle expenses. Your financial future isn't determined by how much money the government sends you or how big your salary is. It's determined by what you do with the money that passes through your hands. That $2,000 stimulus check is going to arrive, and then you're going to make a choice that reveals everything about your financial future. Make it count. If this video helped you think differently about your stimulus check, hit that subscribe button because I'm constantly breaking down how to build real wealth without complicated strategies or getting rich quick schemes. Drop a comment and let me know your income bracket and what you're planning to do with your stimulus money. And smash that like button, it helps other people discover this information before they blow their check on stuff they'll forget about next month. Your future self is watching the decision you're about to make. Make them proud.